Welcome to the MHP Exchange, where the riches are in the niches. We'll show you how to invest your way into mobile home parks with real strategies, tips, and behind-the-scenes know-how to grow your cash flow. Stick around. This is where smart investing begins.
What happens when one of the world's largest private equity firms decides to buy a significant stake in America's last affordable housing frontier? We're about to find out, because as Brookfield has placed a bet and is in conversations with Yes Communities to buy over 50,000 pads in a nearly $10 billion transaction, which will be the largest real estate transaction in any asset class in over 3 years. This will reshape America's trailer parks, and it will impact you if you're in this space, whether you know it or not. Brookfield is a global private equity firm with nearly $1 trillion under management. And they don't, they have a presence in the MHP space. But their focus has always been in infrastructure, in real estate, in durable cash flow plays. And they're looking at Yes Communities, which has over 55,000 pads across 18 states. They're looking at this as a strategic point. Brookfield sees the mobile home park space as long-term infrastructure, not just real estate. So there is another major player that's entering this space. And this is somebody who you cannot compete with if you're a professional real estate investor, or if you're a new investor into the space. This is not somebody that you can compete with head on. After this acquisition, if it goes through, Brookfield effectively controls a national platform. And when Yes Community, which is backed by the Singapore Sovereign Wealth Fund, when Yes Community sells out, or if they sell out, that money's not disappearing. They're going to have $10 billion in dry powder ready to be redeployed in a new wave of acquisitions, developments, debt plays in this space. That money will be put back to work. It absolutely will. It's not going to be, distributed and not put back to work. So this deal doesn't effectively end there. The competition is just beginning. This is essentially starting a new arms race between global capital and every operator who thinks they're playing a local business when they buy a mobile home park. It begs the question, and we've talked about this before. This was in a podcast that I had just a few months ago about Wall Street is coming for your mobile home park. The reason why private equity firms love stepping into this space is because it's been proven that there is the highest amount of same-store growth in the mobile home park industry. There is, in what makes this different than other asset classes inside of real estate, is there is a finite supply of mobile home parks. So as crazy as it sounds, we have a affordable housing crisis that's happening in this country. And I know we've started to see some of that mitigate out over the last few months, but rest assured, throughout the country, there's an affordable housing crisis that's happening. And yet we have mobile home parks, which offer the most affordable housing. They're diminishing year over year. So while there are some new parks being built, primarily in Texas and some of those Midwest states, there is some expansion that's happening. By far and large, more mobile home parks are closing than opening. And the craziest things is that you'll go into some of these communities where there is an affordability issue, and you'll have these communities with empty pads. And why is that? Because in a lot of these counties, in a lot of these cities, there is still the stigma of the trailer park. not looking at it as a affordable housing community. There's the issues of bringing in the homes. Some of these counties and cities make it very challenging and difficult because of past experiences with some of the local operators, and because zoning locks out bringing in or building new parks. There is a diminishing amount, scarcity of the asset, and every year it's diminishing even more. This becomes a huge inflation hedge, it being in the manufactured housing space, because you have the ability here, if inflation ticks up again. This has typically been the most recession resistant of all the real estate asset classes, and there is a stickiness to the resident that is on site. When the resident owns their home, if it's a well-run community, you typically have that resident base for longer. So the narrative here is that Brookfield isn't buying homes. They're buying into certainty. They're buying right now in a world where you still have office vacancy and office towers in a lot of cities, at 30 to 40 to 50%. You have apartments or multifamily, traditional apartments and multifamily that's been over leveraged, and manufactured housing looks like a way to predictable cash flow, to predictable results. But in any transaction like this, and we'll look at it, I mean, there's winners, there'll be losers. And I think there's, for residents, right, because this isn't, real estate isn't about bricks and sticks. It's always about the people. And the important thing to remember is the people on the ground that are going to be impacted by this deal are the residents in these communities. And what it's going to mean for residents if Brookfield goes forward with this deal, I think the call across the industry for more professional management of these communities. And I think the day of, and being in this space for over a decade, when we first started, there was a notion that you could have almost a community mayor, not so much a manager, but someone who would watch the park and could report back to you, maybe handle some showings for you, not necessarily a manager or professional management. I think the call here and the expectation for the residents is going to be for a more professional management on the ground, cleaner communities that are focused on capital improvements. There's going to be, inevitably, there's going to be some rent pressure if Brookfield is going to pay roughly $183,000 a pad across these 18 states, and there going to be probably some rental pressures at some point, and there's going to be a little bit more corporate bureaucracy. So here, in an industry that has been very open, you could probably expect to see a more stricter management style going forward. The silver lining in this is that you'll probably see more consistency in the practices, and you should see a rising of standards across the board. For operators, what this is going to mean is that you're going to have to raise the bar. You're going to have to be able to raise the bar a bit inside of your communities in the services and what you provide for the residents on the ground. And I think the key here is that niche operators, you're going to have to specialize. You're going to have to look in maybe secondary markets. You're going to have to focus on turnaround plays. Not so much the light value add might be more difficult or challenging to find. You might have to find those deals or opportunities with a little bit more hair on it, where there's maybe a hybrid approach that you're going to have to take. Your advantage here isn't going to be scale, right? It's going to be in intimacy. It's going to be in knowing the tenant and the feel of that community, because that's what $1 trillion can't buy, right? When you're at a smaller scale, you can have that feel of what's going on on the ground and have that intimacy. You might not be local, but you could be very hands-on. And for the investors in the space and for the people who have been here for a while, you're getting validation of the thesis of why you've been in this space. You're going to see rising valuations. You're going to see cap rate compression in this space, and your parks are going to become more valuable, especially as these institutions are chasing yield. So as the competition intensifies, you're going to have to be more nimble and creative in the deals that you do have. And you're going to have to look beyond the numbers on how you're really going to force that appreciation and create that community engagement to make those parks more valuable. But I also think one of the pitfalls that this potentially brings in is for the policymakers in the industry. It is very easy for legislators to look at the consolidation that's happening and look at some of the bigger names and create that pushback against those bigger faceless names that are now stepping into the space. It's very easy. It's a good win to go against those institutions. For the operator now, it's more important than ever that you create that community relationships, not just with your residents, but with some of the local politicians in there, and get involved, because you could easily see some pushback and some rent control initiatives that continue to grow. So, I mean, the question here, and one of the topic that we always have on the MHP Exchange podcast, is how to position yourself now. And we look at, you can't worry about what your competition is doing. We're not looking to compete on size. We can compete on value. We can compete on service. We can compete in specialization. We can build a brand that our residents trust, right? We can create community engagement. We can close the gap between mom and pop, amateur, communities, and institutional execution, and create a real value for the residents and for our stakeholders inside of those communities that we're operating in. So my suggestion is, look where those institutional giants can't or won't. And sometimes that's in secondary or tertiary markets. Sometimes that's in taking a little bit more complex turnarounds. You can't out Brookfield, right? But you can build communities that they'll eventually want to buy from you. So guys, if you're out there, if you're looking at the MHP space, if you're looking at getting into affordable housing, this industry is about to be rewritten. The question really is, are you going to get consolidated, or are you going to be the one consolidating? And if you're an operator or an investor now who wants to stay independent but scale, follow this show for more tips, tricks, and understanding of what's going on inside of the industry. And we'll look to deliver that value to you. And if you found value in this episode, I ask that you, on the streaming platform that you're listening to, give us a rating and drop us a line. That's how we get the message out to more people of how great an asset class this really is, how we really impact the people on the ground, and how we grow this channel. I'm Frank Rizzo from the MHP Exchange. Until next time, everyone, happy investing.